Hi, I'm Richard Murphy, and I want to talk about why I do not think that interest rates will be rising at any time in the foreseeable future in the UK, or to be candid, right around the world, because interest rates are pretty much universal these days. Remember, interest rates are very largely under the control of governments now. Pedants will say they're very largely under the control of central banks like the Bank of England. But let's be blunt, the Bank of England is part of the UK government. It's owned by it, its staff are appointed by it, or its most senior staff are, and ultimately the government can tell it what to do. The Bank of England Act 1998 makes that clear. No wise governor would ignore what the Chancellor wants. So let's come back to the point. The government really decides upon our interest rates. So why wouldn't the government or a central bank want interest rates to rise at present, even if there is a risk of inflation, although I don't think there is? The reason is very simple, and that is that because we have had low interest rates for so long, over a decade now, interest rates have effectively been near, in real terms, around 0% when we take inflation into account, and for governments less than that. Because we've had those low interest rates for so long, people have increased their borrowing to reflect their capacity to pay the low interest rates that they're being charged, and therefore owe proportionately more money in many cases than they did before the 2008 financial crash. And this is an ongoing trend. For example, in the last year, UK house prices have gone up by more than 7%. And obviously, the impact of the coronavirus crisis has had one impact there, and the impact has been that people have had more money saved and therefore they've spent it on housing. But the longer term impact is quite simply that there has been a commitment to even lower interest rates as a result of that crisis, and therefore people have also overgeared themselves again. Businesses are in the same position. It's not just households that are mortgaged heavily or which have large amounts of personal borrowing. It is also business that has found itself in this state. Since 2008, it's become commonplace for large companies to pay very high rates of dividends in proportion to their profits earned. In fact, the research that I'm involved with suggests that nearly 30% of UK companies have paid out more in dividends in the last decade than they have actually earned in profit. And they finance this through borrowing. And therefore they now have more borrowing as a proportion of their total funding than they did before the financial crisis in 2008. And of course they've done that because, relatively speaking, the interest rate on that borrowing has been low. But what would happen if interest rates rose? And remember, most companies borrow at rates a percentage point or so higher than the government, but still very low at present, as are mortgage rates in real terms. Well, if interest rates rose, quite simply, the stress on households and on companies would become extremely large. Frankly, some would simply not be able to pay their way. They would face a debt crisis. Some companies could go bust. It is a common cause of companies going bust that they can't pay the interest on their loans. They are what is called, by accountants and others, overgeared because they have too much borrowing. And there are many households who might be in the same state. Quite clearly, just as some people have been buying up and increasing their borrowing during the course of the coronavirus crisis, we are well aware that there are many households who've had to be forced selling to meet the obligations on their debts, which changes in their circumstances, unemployment, furlough and so on, has forced them into. In other words, they've had to literally scale down their activities and move into rented accommodation or whatever to manage the debts that they had. Now, the government cannot afford a debt crisis, quite simply because a debt crisis impacts straightforwardly on our banks. Once we see a range of householders begin to go bust, or once we see a range of companies beginning to go bust because they can't afford to settle their debts, because interest rates are rising, then there's a domino effect. Once people don't believe that house prices will go up, once people believe that there will be more houses on the market, they stop bidding prices up. No, worse than that, they actually hang on to wait for prices to fall. The effect is literally an escalator. The process of going up rapidly turns into a process of steady decline or at least stagnation. And in the case of businesses, it's not just stagnation, it can be a decline, because the impact of a company going bust not only impacts its bank, who now can't recover money, but of course there will also be people it can't pay within its supply chain. And therefore they will suffer a bad debt, and that puts increasing pressure on them if at the same time they've also got an increased interest cost. The fact is that this escalator effect is well known to exist, and the government is, I suspect, although it wouldn't quite put it this way, terrified of it. They're terrified because they believe that an interest rate rise could trigger that debt crisis. And it was, of course, a debt crisis that gave us the 2008 global financial crisis. The inability of people, especially in the USA, to service their mortgage obligations was what literally tripped up the world's banks then. It could trip up the world's banks again. Yes, they are stronger than they were in 2008. Yes, they are full of QE money. Yes, that means that they are in a better position than they were. But it doesn't mean that they are immune from risk. And it doesn't mean that the real economy beyond the banking sector, because the banking sector lives in a world of its own, it doesn't mean that in that real economy there aren't real risks from increasing interest rates. Frankly, we don't want to see people forced out of their homes because interest rates have been increased. And that's a very real prospect. We already know that millions of people can hardly get through to the end of each month, and many of those are on mortgages and not just in rented accommodation. Let's be clear, this is not a problem just in the rental sector. So we know that people are living on knife edges already. We know that there are many businesses which are called zombies, and a zombie business is one which cannot really afford the debts that it is carrying, but survives simply because of ongoing support or there being no pressure, from their banks to actually repay the debt in a hurry, which has been assisted by the whole coronavirus government-backed loan scenario. So we are living in a very fragile economy where interest rate rises could topple things over. Is any government going to take that risk of increasing interest rates? No. Is that true in the US? They're not going to take that risk. Is that true in the EU? No. They're not going to take that risk. Is that true in the UK? No, we're not going to take that risk. So what are we going to do if there's inflation? We're going to increase taxes. That's it. That's what modern monetary theory says you does. If there's an increase in inflation, interest rates are not on the agenda. But that doesn't mean to say we won't tackle inflation. We'll just have to learn to do it in a different way. But what we cannot have is a world which is brought to its knees by interest rate rises. And for that reason, they're not going to happen anytime soon. Thanks for watching. If you're interested in what I've been saying in this video, please subscribe. There is a button below the viewing screen. If you're interested in what I have to say on Twitter, I'm at Richard J. Murphy on that medium. If you want to look at my blog, that's taxresearch.org.uk. And we have a Facebook page as well, Richard J. Murphy. So one of those things will get you more information on what this video series is about, and I hope I'll see you again soon.